going across all of our respective social media channels. So I'm checking right now on Twitter. Looks like that's working perfectly. Hey, everybody. I'm doing these impromptu market discussions with previous people I've had on spaces before. I figured I'd reach out to Tobias, given his focus on value and a very weird year for value, which we're going to touch on for these 20 some odd minutes. So first thing I want to ask you, Tobias, is has this year been maddening for you with AI mania and technology gone wild?
Well, first of all, thanks very much for having me, Michael. I very much appreciate the invitation. I watch your Twitter feed, and you're battling with the with some amusement.
Yeah.
Look, I've actually had a pretty good year, so I'm not. We haven't held any of the Magnificent Seven or whatever we're currently calling the. That's not true, actually. Held Meta, just rolled out of Meta at the last rebalance date, but I can't discuss the securities that I manage or the funds that I manage, but I can tell you in broad terms what the strategy has done. We've sort of outperformed. I think it's been a pretty good year for Deep Value. The last 3 years have been pretty good. 2020 was a really rough year because we were long short at that point, but we're long only now. Since then, I think it hasn't been too bad. And this year has, I think, to be fair, though, a lot of the performance came in June. We had been lagging a little bit until June, and we came off the golf ball off the concrete path in June, and a lot of the year's outperformance has come since June and into July. So I feel pretty good. I still think that there's a very long way to go for value to sort of catch up and justify its existence, but I feel good.
So the March period was kind of a nasty one, right? With the way the regional banks played out. If you look at traditional value versus growth, it's like that's when the value trade for a moment in time, had a real break in its momentum, right? Because of the connection to financials. How important is financial sector momentum to value style investing?
I don't look so much at momentum as a factor, but you're right that value has tended to be more heavily into industries like energy also, because energy's come off a little bit over that period of time, and financials. We didn't hold any financials going into that, but I have picked up one financial on the way through, and we have some sort of exposure, slightly derivative exposure, not literally derivatives, but just derivative exposure through other names. So that it was a stumble, but I think where we have sort of been a little bit lucky is we picked up Meta. I just think Meta got silly cheap at some point last year. We didn't buy it first at $90, but we were buying it at 150. I thought it was quantitatively, it was half price at 150, but at 90 it was less than a third of the price. We got a little bit lucky too with the home builders last year when lumber popped, when lumber got very expensive. And I know you track the lumber prices pretty closely. When lumber got expensive, that hurt all of the home builders, and nobody could have predicted. I don't think. Well, I didn't know anybody who had the thesis that we were going to go into this period where high interest rates would make selling existing homes difficult, which would massively benefit the home builders because they're able to buy down the mortgages and so on. So we got when lumber came back down and the demand for all of those new homes picked up, all of those home builders rocketed. We've got a few, and we've got a few names like Williams Sonoma that sort of sell into that are beneficiaries of that market again, like in a derivative sense. But that was a large driver of the returns, and also energy. I think that it was a pretty good signal when energy went negative. We still need a lot of energy in our in our economy, and it probably wasn't going to be negative for very long. So we've been a little bit lucky with those ones as well.
So energy, I'm sharing some just charts as we're chatting just to kind of make it more dynamic. But the energy's been intriguing, right? I mean, it's kind of the classic, that which killed it the year before ends up not really, broadly speaking, doing as well on a relative basis, right? Energy really hasn't, when you look at the broad-based ETFs, kind of gone anywhere. Do you think that there's, if again, I recognize value versus momentum are different dynamics, but the reality is there is a connection. Do you think that we need to see some kind of breaking in technology strength and hype to get money to go back into energy to break this kind of sideways consolidation that we're seeing?
Yeah, that's a good question. I'm not. what actually makes the stock price perform is always a little bit of a mystery to me. It's not something that's sort of, I think that, I find your discussions of lumber and gold kind of interesting, and because I've watched what you've been saying, and I think that one of the breakdowns often between what we're talking about is I sort of think in a very long time scale. I try to think in like a 3 to 5 year time scale, and I think you're trying to think in a slightly shorter time scale than I am. So from my perspective, I just find it very, I don't really know what prices are going to do at any given point in time. I always assume, and I always joke with my friends, that one of the worst things about being a value guy is you never pick the bottom on any of these things. You buy stuff when it gets cheap, and then you're down 50%, and you haven't really made a mistake. I wouldn't say you've made a mistake at that point. Like, it could just be the price action is just wrong relative to and Meta's a good example of that. I thought it was cheap at 150. At 90, I thought it was silly cheap, but I was down a lot at one point on that position, and that's just the nature of the beast. I agree with you that ultimately it's sort of fundamental momentum in the performance of the stocks that ultimately drives any back test will show you that it's essentially earnings momentum eventually that translates into value. So I have a great deal of sympathy for the approaches that just look at price action as a representative of fundamental action. So I can see that is the case. It's just that I'm not set up that way. I think in terms of value. I would love to understand a little bit more about your gold and lumber. I understand in general terms that lumber is more of an indicator of a better economy, or that people when they're building they buy lumber, and when they're nervous they buy gold. And so when lumber outperforms gold, that seems to indicate that's a more bullish sort of market, and when gold outperforms lumber, that's a more bearish sort of market. Is that a fair description of what's happening?
Yeah, and actually, I'll turn that into the earnings momentum discussion around home builders, because you've got two very different messages, right? So home builders have been on fire, right? And correct me if I'm wrong, but the earnings momentum, I think, from what I've seen, has been there to justify
Huge, yeah.
a good part of that. But the behavior of lumber, which is what home builders use to frame houses, right, it's been very, very divergent, right? Now, I get it. There's all kinds of nuances and things are disconnected still post-COVID, and there's all kinds of other idiosyncratic aspects when it comes to sawmills. But it is, you're thinking about it is correct, but the disconnect, I think, is one that's pretty fascinating. Now, maybe lumber is wrong, and maybe home construction is going to keep on picking up. I mean, you probably know the fundamentals on home builders obviously much better than I would, but it's more of a trading signal as opposed to the long-term dynamic. We know the long-term story. There's underinvestment, right? It's like that's an easy story to tell on the home builders. But let's talk about some of the fundamentals as far as that earnings acceleration. So, aside from home builders, from what you see and what you've been allocating to, where has been sort of where has there been an uptick in acceleration of earnings growth?
Yeah, that's a good question. I still think that energy is, even though the prices have come down a little bit, oil has come down a little bit, because the earnings is backward looking, and they've had a few bad years, and then they've had a few good years. Even though we're sort of bumping sideways and down a little bit from oil's peak, probably up a little bit from the bottom. We're just sort of in that middle territory. The companies are still doing pretty well. They're still all earning, and I think that the earnings are still looking stronger. The nice thing about this time around, often you find this in commodity companies when they're closer to the bottom of their cycle. They've just gone through a rough part of the cycle. The balance sheets look really good, and they often get religion about capital allocation, so they're much better at paying dividends, buying back stock, doing all that sort of stuff, rather than doing expensive mergers and acquisitions, or competing. So we all remember what happened in the shale when shale got really hot. There was a huge amount of money invested in shale. I don't know if I don't know if this is still true, but at some point there was basically the total amount of money invested in shale was less than the money that had been taken out of shale. It may have paid out to this point, but shale was tough for a long time there. But I think that that's not true anymore. I think they've cleaned up their balance sheets. I think they look good now, and I think that they've got some religion about that. So I like energy. We're basically up to our risk limits on energy, and the names that we buy tend to be a little bit more off the run, because we can invest in smaller companies and so on. So without sort of mentioning names, the biggest holding in the fund at the moment is energy, and we've also got some basic materials, which are sort of energy type things, so some coal and other holdings like that.
In general, do you find there are more value opportunities in small caps versus large caps, just given the way that the two have in particular behaved this year?
So it's an interesting question. I track because I run two portfolios. I run a mid and large portfolio, and I run a small and micro portfolio. And the funny thing is that the dividing line between the two is mid and large is the largest 25% of stocks by market capitalization, and small and micro is the smallest 75% by number. Sorry, so there's many, many more in small and micro than there is in mid and large, but the universe by market capitalization is much, much bigger in mid and large than it is in small and micro. Even so, even our mid and large cap fund is sort of much more positioned close to the very bottom of that size scale. And there's multiple reasons for that. If you just think about a multiple on a stock, if it's got $100 million in earnings and it's trading at a 10 times multiple, it's $1 billion market cap. And that's a small and micro stock. But there are many stocks around with $100 million in earnings that are on a 50 times multiple, and they might be a much, much bigger stock. So value and size tend to be correlated largely for that reason. I track both. So I think about valuation, not just in terms of the multiple, but I look at various other things like the amount of money that they're earning and what they've got invested in their company, so return on invested capital, and their ability to keep on reinvesting at those rates, what the incremental growth rates look like, what that means for the next few years. And so I can derive an expected return from that. And it's moved around a little bit over the last few years. I would have said in 2020, at the bottom, the small and micro was unequivocally cheaper than mid and large. And there was a period of time from about October 2020 until about May 2021 when small and micro value in particular just squirted up. It was a very rapid rise, and it's basically bumped sideways since then. And mid and large sort of traveled along at about the same pace, but not quite as pronounced. And so for most of the last year, I would have said mid and large was cheaper. But I think now it's pretty clear, if we're looking forward, that small and micro is a little bit cheaper. And you can see there are any number of charts out there that show how, whether you're looking at performance or whether you're looking at valuation, small and micro is incredibly cheap at the moment relative to the rest of the market. So yeah, I think that I think that probably it's just the nature of the markets that the last 10 years have been big and growth, and it's probably likely the next decade is sort of the reverse. It's small and value, and it just seems to be the nature of the beast.
It's also a thing where the fundamental analysis is even more important, right? Because if you're smaller, you probably have higher leverage ratios anyway.
Yeah, I think that what really stands out in the small and micro companies, they're just not, the businesses just aren't as good. They're not as diversified. The management teams are less seasoned. The management teams tend to be, although I think this is generally a positive, but they're often entrepreneurs who come from an engineering background, and it's a slightly different skill set managing professional managers know about buybacks and so on. And so just the lack of diversification in their businesses, product lines, lots of other things make them a little bit less sure than the bigger companies. But having said that, it makes the job for someone like me, like if I'm looking for high quality businesses in that vast pool of companies with good balance sheets, that really is an opportunity for fundamental investors to sort of stand out, because the index tends to be quite junky, but you can narrow down to a handful of names that do tend to be quite strong in there. So I think that it really does pay fundamental analysis in small and micro world. In the larger world, it's sort of got to be that, you've got multiple analysts picking the next earnings to the penny, and that's a much, much more difficult competition.
I see Alex from YouTube making the point that Meta, Intel, all at crazy discounts. Since you touched on Meta, actually just put a piece out on Intel myself recently, because all the focus is on NVIDIA. But Intel is now also trying to get into the space more aggressively under their leadership. Any thoughts on Intel, just given what Alex has said on YouTube here?
Yeah, I held Intel. I picked it up when it first got beaten. I'm not entirely sure when that was, but a few years ago now, 2020, something like that. And I ultimately sold it at a loss. It hasn't come back into my screens just yet. I really love Intel, and I think that it should be a beneficiary of political geopolitical things that we're seeing. I think that there's a lot of energy, or there's a lot of there's a desire to bring that manufacturing back to the States, and I think that for geopolitical reasons and for domestic political reasons, and I think it should be a huge beneficiary of that. It just hasn't done it yet. I'm watching it very closely, and I do think it's got, it's still a pretty great business. It's just they're stumbling a little bit at the moment. What did you think? What was your conclusion there?
Well, I mean, it's a relative valuation argument, obviously, although everything relative to NVIDIA
to AI,
right?
NVIDIA.
It's very clear, right? It's like that's the thing I always poke fun of. Which, by the way, folks, I don't have any position in. I could care less about NVIDIA. To me, it's more of a symptom of overconfidence. And it's like I joke, Graham and Dodd, they didn't know anything about gamma squeezes, right? Like we're seeing now.
Is that what drives? Do you think that's what drives these?
I don't know. Look, you've been in the business long enough, and so have I, to know that sometimes prices move and start their momentum in irrational ways. And sure, the earnings beat can be strong. Yeah, sure, the future can be phenomenal. But I always go back to price is not driven by company fundamentals all the time, right? So, but the price of NVIDIA is not being driven based on AI; it's based on people. Right? And manic, depressive behavior, which is always there in markets.
Does it feel like it's getting faster? I've been managing the fund since 2019, but I've been in markets before then. But even since we launched in 2019, we had 10 months to COVID, which was that was basically a flash crash. It was over, inside the month, but it was still the fastest drop that we've had. I think it's now quicker than 1987. So that's a real, if you live through that, you've seen something, very unusual in the market. And then we've had that monstrous rally that followed on the back of that, and then basically 2 years of kind of misery for everybody, but particularly for the growth here. And now here we are back in 2023, where it's the Magnificent Seven rocketing. NVIDIA's 50 times sales or something silly like that. I try not to. I used to short, and I don't short anymore. Not that I would short NVIDIA. I'd never short anything with it that was spiking like that. But I still, of course, I still have my short screen. I still look at what's in the short screen, and I still think about it. And I was a little bit, honestly, I was glad that I wasn't shorting when this year took off. But now I look at my short screen, and I think there's a lot of pretty fat shorts lying around in there. So I think that,
and by the way, real quick on that point about speed is an interesting thing to think about in markets. So one interpretation of markets move faster, which means they're more efficient, right? Information is priced in quicker, right? But the other part of this is prices are moving so fast, I think, actually, because markets are more inefficient because of the ease of which people can lever, do zero DTE options. People that are not necessarily traders or investors or even know anything about investing, just kind of YOLOing, right, very easily, from their phone. So you have an environment where the speed, I think, is more a reflection of emotional biases by what I term uneducated speculators, which for value people longer term should be even better because it makes it even more clear what's a better investment as opposed to something that's a trade of the moment that people might be making a lot of money off of, but who knows in 10 years if it ends up being like Cisco.
Well, I couldn't agree more. And I sort of rely on people being irrational in the market. And there's research from one of the very, very early papers, the 1991 paper, which is about one of the early ones that suggested that there might be sort of a behavioral element to the efficient markets hypothesis. So the behavioralists were on the other side from the efficient market guys. And they say there are essentially two groups of people in the market. There are contrarians who are sort of relying on mean reversion in the underlying business and security prices and so on. And that's the camp that I am in. And that's the camp that I believe. And I believe in that sort of behavioral camp more than I prefer the efficient markets camp. But on the other side, of course, are the they call them naive extrapolation investors who have those biases, who look at a chart or look at a earnings stream and think, well, that'll keep on going, and just extrapolate that out to the horizon. And of course, that they much more often break down than they sort of rise up to the horizon. Although the difficult thing, I think, for the last sort of 10 or 15 years has been that many of those big companies like Google or Microsoft, which are very, very good businesses, but in some sense, they've defied a lot of the base rates that had pre-existed. They've just got much, much bigger and earned so much money at a scale that we'd really never seen before. And so that's why a lot of value guys were sort of skeptical about even, Google or Amazon about those runs, thinking at some point this comes back to earth, but they never have. And I think it's because it's a different business model. There's one screen. You manage one interaction with the customer as the business, and that's sort of what has allowed them to become so much, to scale to such size.
I see Raleigh saying that I lost a lot of hair because I shorted markets. By the way, I don't believe in shorting.
I got a lot of
I'm
gray
losing hair because this is a hard ass business, folks. That's the reality when you're running capital and doing as much as I'm doing and Tobias is doing. Shorting is the problem. I always go back to the like, I get it. Some people can do it successfully, but ideally you want an imperfect hedge. Imperfect because the timing has to be perfect otherwise. Right. That's why in my world, the defensive risk off expression is treasuries, utilities, dollar, gold, more so treasuries, which maybe is a good place to wrap this up because I have to assume a connection between rates and value opportunities, right? And particularly maybe on the duration side of things. Now, I happen to think that we're probably going to see even further inversion. Long duration treasuries could keep on dropping on the long end as the Fed keeps on trying to hike rates to break inflation faster. What happens historically when you have inversions to the value style?
Do you mean the 10-3 inversion or the 10-2 inversion?
Yeah, well, in my case, much longer out, but yeah, I mean, essentially, right.
Out of value tends to be quite sensitive because it's that, as we pointed out before, there's financials and energy. There's a lot of cyclicals in there, so I think value tends to sell off first, and then we have the rest of the market sell off at some point. When you see those 10-3 inversions, I mean, the track record on that is pretty solid. It's not saying that's going to work every time. It's just that there have been about 8 examples in the data set, and they've all led to recessions, and they've all led to ultimately a stock market crash. If you can look now, there's earnings are off 9% from the peak. That's the largest earnings recession that we've seen outside of an economic recession. And so I just think it's inevitable that any day now there's a recession declared. The funny thing is that the old wisdom used to be that when the recession was declared, that was basically the bottom of the market, and the market took off. But here we're much, much closer to all-time highs than we are to the all-time bottom. So I don't really know what happens here, but I suspect there's probably a nasty crash at some point. And that's often good for value because being economically cyclical, sensitive and cyclical, it comes out of the bottom much, much faster. So I would love a crash and a recovery if I can make it to the other side. I'm looking forward to something like that. So I think it'll happen, and I want one to happen, but who knows? As the timing, that's someone else's department. That's not mine.
Good place to wrap this live random impromptu discussion. Everybody, please make sure you follow both of us. Click that notification bell. I'm going to try and do these occasionally, kind of impromptu, as I say, surprise and delight type of conversations, just fast with people that I think are very intelligent. Tobias, always good to connect with you, and hopefully I'll see everybody later.
Thanks for having me, Michael. I really enjoyed that. It was fun.